macro currency signals.
Right now, something extraordinary is happening in the silver market. Not quietly, not gradually, but in a way that demands attention. The price has surged past levels that many believed would take years to reach. And yet here we are, silver trading above $80 in early morning action. Shocking skeptics, electrifying believers, and forcing the entire financial world to look again at a metal they have long underestimated. But here's the real question. Is this the beginning of something historic, or the final surge before a brutal reversal? 9 consecutive winning months. Let that sink in. Month after month, silver has climbed higher highs, higher lows, momentum building like pressure beneath a volcano. If this month closes positive, that makes 10 in a row. A streak of that magnitude doesn't happen in a calm market. It happens when forces are shifting underneath the surface. Volatility is not a warning sign. It is a symptom of structural stress. When price begins to move this aggressively, you are no longer dealing with simple supply and demand. You are witnessing a repricing event. And repricing events are rarely smooth. Before we move forward, if this viewpoint resonates with you, take a second to subscribe and turn on notifications. In an environment like this, being informed in real time isn't just useful, it's strategic. Positioning yourself early rarely feels comfortable. It's usually unpopular, but that discomfort is often where the greatest asymmetric opportunity exists. Leave a comment below and tell me where you're watching from and what time it is where you are. This conversation isn't confined to one country, one currency, or one market. It's unfolding on a global scale. And when you start to see how widespread these signals are, it becomes clear that this story is much larger than any single headline. Now, let's return to what's quietly shifting beneath the surface. Silver has always been different from gold. It is smaller, thinner, more emotional. It moves faster on the way up and more violently on the way down. It is both an industrial metal and a monetary metal. That dual identity makes it uniquely sensitive to global instability. It reacts to inflation fears. It reacts to geopolitical stress. It reacts to industrial demand. And when all of those pressures align at once, the result can be explosive. The surge above $80 is not random. It follows months of tightening supply conditions, rising physical demand, and persistent distrust in paper markets. Investors are not just buying silver contracts, they are buying bars. Coins, physical bullion, they are taking delivery. That changes the equation. Paper markets can create the illusion of abundance. Physical shortages expose the truth. The most important question now is not how high silver has gone. It is where the floor might be. Markets rarely move in straight lines. Even in powerful bull markets, corrections occur. Pullbacks test conviction, weak hands sell, strong hands accumulate, but a true bull market has a floor that rises over time. Each correction finds support at a higher level. There is increasing discussion about a possible structural floor emerging in silver, a price level below which sustained declines become increasingly difficult. Some suggest the floor may now sit dramatically higher than anyone expected just a year ago. When price surges this quickly, and then consolidates without collapsing, it sends a message. Buyers are waiting. If a floor forms around the mid-60s, that would represent a complete regime shift from the previous cycle. It would mean that what used to be resistance has now become support. Markets flip like that when psychology changes permanently. And psychology has changed. For years, silver was ignored. It lagged. It frustrated long-term holders. It traded sideways while other assets soared. But beneath the surface, something was building. Mine supply growth was stagnating. Industrial demand was rising, especially in sectors tied to electrification, solar infrastructure, and advanced manufacturing. At the same time, global debt was expanding at a historic pace. Debt expansion always has consequences. When currencies weaken under the weight of debt, hard assets reprice. Sometimes slowly, sometimes all at once. Now consider the geopolitical backdrop. Tensions between major powers are escalating. Trade disputes are intensifying. Sanctions are weaponized. Energy routes are threatened. In that environment, capital seeks safety. It does not ask permission. It moves. Precious metals are historically among the first beneficiaries when geopolitical risk accelerates. Not because they generate cash flow, not because they innovate, but because they are no one else's liability. That distinction becomes critical during periods of uncertainty. When trust erodes, tangibility gains value. Silver is uniquely positioned in this environment. It is affordable compared to gold, making it accessible to a broader base of buyers. That accessibility can create rapid momentum shifts. When fear spreads through markets, smaller investors do not typically rush into complex derivatives. They buy something they can hold. Silver coins, silver bars, junk silver, bullion. The physical market tells a story that paper charts cannot fully capture. Premiums above spot price have widened. Delivery times have extended. Retail demand has surged during dips. That is not speculative frenzy alone. It is accumulation behavior. But let's confront the other side of the argument. Could this be a blow-off top? Parabolic moves often end violently. When price accelerates too far above long-term trend lines, gravity eventually pulls it back. The faster the rise, the sharper the correction can be. Volatility cuts both ways. If silver were to fall back below key breakout levels, sentiment could shift quickly. Momentum traders would exit. Leveraged positions would unwind. Headlines would shift from celebration to panic. That is why identifying a floor matters. If the market consistently defends a certain range during pullbacks, it confirms underlying strength. If instead, it slices through previous support levels without hesitation, that signals fragility. Right now, silver stands at a crossroads. Another factor intensifying the situation is the gold-to-silver ratio. Historically, this ratio has expanded and contracted in cycles. When silver outperforms gold aggressively, the ratio compresses. In strong precious metal bull markets, silver often leads in percentage terms. If gold continues climbing toward new records, silver's relative performance becomes even more important. Should gold enter a major revaluation phase, silver historically amplifies those moves. But silver does not need gold to justify its own rally. Industrial demand alone has become a powerful driver. Electrification of transportation, expansion of renewable energy grids, data infrastructure growth. Silver is embedded in these systems. It is not optional. It is conductive, efficient, and difficult to replace without sacrificing performance. When monetary demand and industrial demand rise simultaneously, supply constraints tighten quickly. Mining output cannot surge overnight. New projects take years to develop. Environmental regulations, capital constraints, and geopolitical risks in producing regions limit rapid expansion. Meanwhile, stockpiles decline. This imbalance creates vulnerability. Now layer in currency dynamics. The global reserve system is under strain. Countries are diversifying reserves. Bilateral trade agreements are bypassing traditional settlement mechanisms. Central banks are accumulating gold at a historic pace. Silver has not yet seen the same institutional accumulation as gold, but if confidence in fiat currencies deteriorates further, spillover demand could flow into silver aggressively. The concept of an official or unofficial price floor introduces another dimension. When policymakers begin discussing stability measures in commodity markets, it signals awareness of strategic importance. Silver is not just jewelry. It is critical infrastructure material. It is defense material. It is energy transition material. Governments rarely intervene unless something matters. If stabilization mechanisms are considered, it would mark a turning point in how silver is perceived at the highest levels. Markets respond to perception shifts long before formal announcements. Volatility from here is almost guaranteed. After a surge above $80, traders will test the market's resilience. Profit-taking will emerge. Short sellers will attempt to fade the move. Headlines will oscillate between euphoria and fear, but the larger trend depends on structural forces, not day-to-day noise. A 10-month winning streak is not a coincidence. It reflects sustained capital rotation. When an asset class delivers consistent gains across nearly a year, it signals underlying demand persistence. The critical observation is whether corrections are shallow and brief or deep and prolonged. If pullbacks attract immediate buying pressure, it suggests long-term positioning rather than speculative chasing. If dips trigger cascading sell-offs, that implies leverage-driven fragility. So where is silver going from here? Short-term, expect turbulence. Wide intraday swings, rapid sentiment shifts, social media explosions, headlines declaring new eras one day and collapse the next. Medium-term, watch consolidation patterns. A healthy bull market often pauses after major breakouts. It digests gains. It forms a base at higher levels. It shakes out excess leverage. Long-term, the macro landscape is arguably more supportive for hard assets than at any time in recent decades. Debt levels are extreme. Monetary policy credibility is questioned. Geopolitical fragmentation is accelerating. Energy transitions require vast material inputs. Trust in centralized systems is fragile. Silver sits at the intersection of all of it. The real shock may not be that silver crossed $80. The shock may be how many still believe that is the peak. If a structural floor truly forms near the mid-60s, the entire long-term chart reconfigures. The ceiling rises dramatically. Previous all-time highs become stepping stones rather than barriers. But nothing moves without resistance. Expect attempts to suppress volatility. Expect narratives minimizing the rally. Expect dismissals, labeling it speculative excess. Markets with strategic importance rarely move uncontested. And yet, Price is truth. If silver continues holding elevated levels despite pressure, it signals something deeper. It suggests accumulation by participants who are not trading for quick profit, but repositioning for structural change. Watch the physical market closely, watch inventory levels, watch industrial procurement contracts, watch geopolitical headlines. These will tell you more than daily chart patterns alone. Because this moment is not just about silver crossing $80. It is about whether we are witnessing the early stages of a monetary shift. And if we are, then volatility is not the enemy. It is the announcement. Now let's step back and look at what this really means. When an asset moves this aggressively, the conversation changes. It is no longer about whether silver can rise. It becomes about how the system reacts if it does. Because an $80 silver price is not just a chart milestone. It is a signal flare. It signals stress in currency markets. It signals strain in supply chains. It signals capital moving defensively. And the higher it climbs, the louder that signal becomes. But here is the uncomfortable truth. Markets do not reward complacency. After 9 straight positive months, after a surge through psychological resistance, the probability of sharp corrections increases. Not because the bull market is over, but because bull markets breathe. They expand, they contract, they shake confidence before moving higher. Volatility from here is not optional, it is inevitable. You could see $5, $10, even $15 swings in short order. Fast rallies followed by violent pullbacks. Emotional headlines, sudden spikes in premiums. Panic buying one week, fear-driven selling the next. That is how powerful revaluations unfold. The key question is whether pullbacks are bought aggressively. If silver dips and physical demand surges, that confirms underlying strength. If it dips and buyers disappear, that suggests fragility. Another major factor is the gold to silver relationship. Historically, when gold enters a major upward repricing phase, silver often accelerates even faster in percentage terms. If gold were to push dramatically higher in coming years, the implications for silver become exponential, because silver is smaller, thinner, easier to move with concentrated capital flows. If gold climbs into a new long-term valuation range, silver does not merely follow, it tends to overshoot. Now add geopolitical escalation into the mix. Rising tensions in energy corridors, sanctions expanding, strategic alliances shifting. Every escalation increases the appeal of tangible assets. Not for speculation, for security. Silver benefits from both monetary fear and industrial necessity. That combination is rare. On one side, investors see it as protection against currency debasement. On the other, manufacturers cannot simply eliminate it from production lines. Solar panels require it. Electronics require it. Advanced infrastructure requires it. When fear-driven demand and industrial demand collide, supply pressure intensifies quickly, and supply is not flexible. Mining output cannot double overnight. Exploration pipelines are long. Regulatory hurdles are real. Capital costs are high. Years of underinvestment compound the issue. That is why sudden repricing events can happen so violently. The market wakes up all at once to constraints that have been building quietly for years. If policymakers even begin discussing stabilization measures or strategic considerations around silver, that alone changes perception. Markets move on perception before policy is formalized. Which brings us back to the idea of a floor. If silver consistently finds support in the mid-60s after this surge, that becomes the new battlefield. That becomes the line that bulls defend. And each successful defense strengthens the foundation for higher levels. But if it slices below that region decisively and fails to reclaim it, confidence could unwind quickly. So what happens next? Short-term turbulence, medium-term consolidation, or violent retest. Long-term determined by currency credibility and geopolitical stability. If global tensions cool, inflation stabilizes, and trust in monetary systems is restored, silver could normalize at lower levels. But if debt expansion continues, if geopolitical fragmentation deepens, if currency confidence erodes further, then $80 may eventually look conservative. This is not about predicting tomorrow's price. It is about understanding the environment. Silver is reacting to something bigger than technical momentum. It is reacting to structural shifts. And structural shifts do not resolve in weeks. They unfold in cycles. So when you hear that silver has surged past $80 and ask, what is it about to do? The real answer is this. It is about to test the system. It will test investor conviction. It will test supply limits. It will test monetary credibility. Expect volatility. Expect noise. Expect sharp moves in both directions. But above all, pay attention to the floor, because if silver refuses to fall the way many expect, then this is not just another rally. It is the early chapter of a much larger repricing story, one that could redefine how the world views money, metals, and stability itself.